stock market investments and investing for your future. Alan Tithing. Alan is a regulated financial advisor who enjoys helping his clients map out and secure their financial futures. He enjoys taking annual holidays back home to Cape Town and lives with his wife, dog, and 2 children.
Over to you, Alan.
Good morning. Can you hear me there?
Yes, we can.
Good, brilliant. Hi, morning, everyone. My name's Alan. As the introduction said, I'm a financial advisor, regulated financial advisor. We're based in Milton Keynes, but we have clients throughout the UK, effectively. And one of the kind of silver linings of the last 2 years pandemic has been a bit of a more embracing use of technology, which has kind of streamlined our business and a lot of clients' businesses, being able to do things remotely, and it's become more accepting. But I thought today I'll just give a kind of a brief outline of kind of where we are in the markets and kind of what the opportunities are in terms of investing money. I know there's been some great insights from previous speakers about the various asset classes, property. There's been mention of Bitcoin and cryptocurrencies and NFTs. Some of them I know a lot about, and some of them I'm kind of still standing on the fringes, just kind of looking at and see how these things play out. But what we generally do with clients is focus on the bigger picture stuff, looking at putting kind of a robust framework in place for your long-term plans. So let me just share my presentation quickly, and we can get started. So what the last 2 years it's kind of been. I mean, I joke around with a lot of people saying it's been a B-grade horror movie the last 24 months we've lived through. There's pandemics and insurrections and wars, and we're currently going through a bit of a correction in the stock markets. And none of these things feel nice when you're in them, but generally, these things have happened in the past, and the likelihood is they're going to happen again and again and again. And it's being able to take a step back and focus on the big picture stuff and get the right framework in place, so you kind of don't make rash decisions which could impact your future in terms of investing. One of the things we kind of try and instill with clients is, we're all on this planet. It's a journey for us. We might as well try and enjoy it. And a couple of things you can kind of put in place in terms of building blocks to try help you and facilitate a more smooth transition through this wonderful life we've been blessed with. One of the key things is, do you have a goal, a direction? Where do you want to ultimately get to? And if you've got an end point in mind, it's a lot easier to build the roadmap and see which ways you can get there, and which ways have fewer speed bumps, and which kind of ways may lead to a bit of adversity. And if you've got a destination in mind, it absolutely sets you up to try and get there. As some of the speakers have been mentioning before, Stella, a very inspiring story. Life has an odd ability to throw curveballs at you, and if you haven't had a curveball lately, best you look around the corner, because there's likely to be a curveball thrown at you. And all these little knocks that life throws at us prepares us to move forward, and gives us the opportunity to overcome them, and again learn from them, and reassess the mistakes you possibly have made, and try not to do them in the future. So it's very important to as I say, get a framework in place, build on that framework, assess that framework, and evaluate it, and make sure are you continually heading in the right direction, the direction you want to do. I should imagine the vast majority of speakers here, I'm from South Africa, Tendai, Zimbabwe, the speakers been from Nigeria and around the world. We've all faced that adversity of having to kind of leave our homeland and make a new life. I mean, that's absolutely a massive undertaking. And a lot of times it's landing with a suitcase and, a few pounds in your pocket, and that's it. And you've got to start from scratch. So it's about overcoming that and putting the next steps in place. And as I say, taking one step at a time. I do love this quote from Martin Luther King. You don't actually have to see the whole staircase, but just take the first step. And, it's about that, putting a bit of faith in your process and a faith in your journey. And again, looking back and being able to see that you're actually moving forward. This is the great thing with Tenda and these conferences she does and the help she does with people is, that's a sounding board that is a great mechanism to kind of assess where you are. So in terms of planning, and investing, I mean, ultimately, what are we trying to do it for? Yes, you want growth, you want your money to grow, but ultimately, why do you want your money to grow? And it boils down to a real factor that's been with us since, time immemorial. And that's inflation. And the fiat currency is the currencies that the paper-based currencies effectively are controlled by the governments that we're in. So obviously the UK is the pound and the dollar, and Dubai dirham is pegged to the dollar, and all these things effectively decrease over time. And this is just a stark example of what inflation can do to your money. And the members on here today from Zimbabwe are probably the most aware of how currencies can be decimated over, through government's lack of fiscal responsibility. A pint or a 4-pint milk, so that's about 2.2 litres, cost 8p in 1920. And today that gets you 17 teaspoons. And this is from 2020. So we're probably knocking off about 15% of that. So we probably get 13 teaspoons of milk from your technically your 8p. So this is what, why we need to invest and why we need to make sure our money is working for us. For those of us fortunate to be in the UK or, in countries that have a nice fail-safe, we have a state pension here. So, if you did nothing, if you kind of just literally worked your whole life, paid off your house, didn't put anything away, people in the UK and the States and other developed countries, will have an opportunity to get a state pension. In the UK, it's currently 9,627. It's going up again in April. And that might be a lot if you kind of go back home and that, but in the UK, that kind of gets you just the bare essentials. I mean, that literally keeps the lights on and a bit of food in the fridge. So this is, again, a driving factor of why you need to make plans and put things in place. If you are working and, trying to build your life, it's about, taking that step back, reassessing things and saying, okay, well, we've got a bit of spare money this month, or, we're going to regularly have a bit of spare money, and what can we do with it? So there is hope. This is what keeps me in a job day to day in terms of looking at the options available. And every kind of investment out there is looking at using a fundamental principle in terms of compounding interest. Albert Einstein called it the eighth wonder of the world. And it's a very simple concept. Money does make money. If you've got nothing to invest, it's very difficult to make anything out of nothing. But if you are able to build up money, and once you throw in the interest and the tax relief that we get in certain investments, your money does exponentially grow, compared to just literally saving it in a bank account, where the likelihood is over time you are going to underperform inflation. So the value of your pound or your dollar or your yen or your dirham is going to decrease over time. This is a calculation that I love. What is the easiest way to get to £1 million? And probably if you're my age, I'm 43 or 43 next month. It's never too late to start, but for starting things very, very small does make a huge difference. And the whole concept of compounding is the longer the investments are in there, the more it's got time to work. If anyone has young kids, if you start a pension for them at the age of, or at their birth, with just £25 a month with the tax relief and things like that, and you get about 8.5-9% return, they'll likely have a £1 million pension at the age of 67. That annual interest rate of 8.5, it does sound high in terms of savings, so you're probably unlikely to get that. Or if you did get 8.75% on, or 8.5% on savings, that means inflation is probably at 10%. So the only way you're going to get that is making use of the mechanisms of the markets, and certain investments in the stock market. In terms of us and how we're wired, and I've got clients from all over the world, and when the markets go up, they generally are happy, and the phone calls don't come in. And when markets are doing nothing, it's a similar kind of scenario. But when markets are down, people start to panic. And it's about taking that step back and reassessing things, and ultimately looking at your roadmap. What are you doing this for? Do you believe in the structure of the markets? And at Odyssey, we firm believers in let the markets do the work. You're not going to be able to second guess the market as an individual. The likelihood of the probability of you being able to pull out that single unicorn, being able to buy into Amazon when Jeff Bezos was sitting in a garage in New York, or catching Bill Gates just as he left, dropped out of university. Those things are 1 in a billion. So it's unlikely that you're going to be able to find that unicorn or that sparkle of gold and invest in that. And if you do, brilliant, congratulations. But the likelihood is, you've just got to put in the hard graft, do the work, and rely on markets and invest on a regular basis. This is a thing I normally do for clients in a meeting, and especially clients who haven't invested before. When markets going down, the first box, everyone's in a panic and worried. And the speaker before mentioned the fear index. Currently it's at the most extreme level, of kind of bearishness. We had a story when we were children about Chicken Lick and then the sky falling on his head, and that's kind of where we are at the moment. In the exact time now, markets have been absolutely battered. Some of the indexes are down 25% in the last 6 months. We've had probably the worst first quarter or first 2 quarters in the last 50 years in the markets. It's been slightly different to the kind of COVID stuff we had in beginning of 2020. That was a very, very sharp correction. And the nice thing in a way, that was quite understandable. Every client we spoke to kind of realized there's a virus. We don't really know what's going on. It's killing people. There's a good reason to be panicked. This time it's a bit more nuanced in terms of the markets. This kind of slow decline has been generally down to the Federal Reserve in America raising rates and saying they're going to stick to it come hell or high water in terms of raising rates. And that's kind of not drained the liquidity out the market, but that's definitely put some pressure on the expectation. And that's what markets are. So when markets are going down, people are kind of panicked, and when markets are flat, it's kind of baseline. And when markets are going up, everyone's enjoying the wealth or the perceived wealth. But what people don't realize is this is a daily basis. I mean, markets are going down on a daily basis. They're going sideways, they're going up. And, it's about being able to take that step back. If you're buying a portfolio or you're buying into shares, it's riding that wave. And, where's the expectation of that wave going? And it's going to go up over the long term. Short term, absolutely, it's going to have ups and downs, and this is a classic example from 1970. I mean, I've got one where there's about 150 items on there, so you could literally throw a dart and you're bound to hit a crisis at some point. And if you invested at a peak in, pick a date, 1988, or just as the UK almost, or 86 when the UK, broke the currency, effectively, if you invested there a year later, you would be down, it would be panic stations. But if you just look at, if you're just stuck in with the investment and let the markets do what the markets do, you're going to ride that wave up. The example I always give clients is, you want to be the super tanker going across the ocean. With some things you can jump in a little speedboat and try to outperform the super tanker, and sometimes you'll be able to do it. But for the whole, for your foundational wealth creation or building for your future, you kind of want to be on that super tanker, and that's just letting the markets do what the markets do, investing in good, well diversified investments. This is just a more UK centric example. From 1956, if you invested £1, if you just left it in the bank, you'd probably just underperform inflation, the grey box. So you'd probably end up with about £20, where inflation would be £26. And if you invested in just the UK market, it would be over £1,000. And, if you went kind of towards the upper end of the risk scale, more UK smaller caps, it would be nearly £11,000. So what any asset class has in common is, if you let them do their job, you don't try second guess them, you're generally going to be able to ride that wave up. Short term, absolutely, it can be an incredibly rocky ride. But the analogy I always give clients is, treat your investments like a bar of soap. The more you touch them, the smaller they get. If you're making kind of day-to-day tactical, unless you're a trader and you've got a trading, agenda and a strategy that you're sticking to, then you can. But if you're not, you're just long-term investor, you've got to let the markets do the work, and you've got to ride the ups and the downs, knowing that in the long term, in 10 years, you're almost not guaranteed, but there's a very, very small probability that you would lose money over 10 years. And over 20 years, there's almost no chance in a well-diversified portfolio of you losing money. This is just a snapshot from last year of what the kind of world markets look like. You can see the big box on the left is the United States market, by far the biggest stock market in the world. Nearly 2/3 of all value in the world is made up of the US. The most recent kind of bomb going off in the market is in terms of markets has been the Russia kind of market. There's been an embargo. If you live in the States, you live in the European Union, or live in the UK, you technically can't touch anything Russian. So that market's been frozen out technically. So if you had any Russian investments, they're just sitting there in technically limbo, and we're not quite sure how they will be allowed back into the international community if they start to play nice. But I suspect Russia is going to be in the naughty step for quite a few years. But just to give you kind of a scale, Russia's kind of, if you look at it like 11 o'clock, you'll see the little box. And if you just kind of go back to the US, you'll see what the market value of Apple is. So Russia is about 1/8. The Russian stock market is about 1/8 the size of Apple alone as a company. The UK is just, probably the stock market is, 3 times to probably about double the size of Apple. So this is the key driver in terms of, we've grown on about diversification and, being able to pick countries or things like that. And, what this gives you a breakdown of is, can you pick who the next winner is going to be? And I've got these various scatter graphs for asset classes, for different types of investments. This is just on a developed market return. So if you just look at on the far right, 2021, the top performing country was Austria at 42%, and the bottom performing country was New Zealand, and probably because of, they went into complete lockdown, and, the economy obviously shrunk. Tourism makes a huge proportion of the economy. And if you look a couple of years back, 2019, New Zealand was the top performing. So, do you have a crystal ball to pick the next winner? And the likelihood is you don't. You might get the next one right, but you're definitely not going to get the next kind of 10 right. And so this again comes down to what can you do to get exposure to these markets. And what we tend to do, and the philosophy that we do, is we allocate according to the economies of the market. So the majority of clients' portfolios are going to be have exposure to the US because it's the biggest economy. Because we're in the UK, we obviously have a slight tilt to the UK economy, and the likelihood is most clients are going to be retiring in the UK if they live in the UK, or their asset base is going to continue to be in the UK. So in terms of investing, it doesn't matter what you do. The number one game in town is reducing your risk as far as possible, having exposure, but don't take unnecessary risks. So one of the key things you can look at is diversification. Don't put all your eggs in one basket. If you're dabbling in property, we love property as an investment, but don't have everything in property. If you want to dabble in crypto, absolutely go for it. It's you could have made a lot of money, but don't have everything in crypto. It's about a well-diversified portfolio. And I always say to clients, if they're coming to see me when they're coming up for retirement, I'll much rather have 6 arrows in my quiver to attack their retirement income. If they've got a couple buy-to-lets, brilliant. If we've got a really nice pension pots and ISAs in the UK, absolutely brilliant. And if they've got a bit of exotic, unregulated investments, 5%, and even hard currencies or metals, actual gold holdings. That is just another quiver in our bag to kind of make sure we can reduce the risk as far as possible. So in terms of what is the best solution going forward is as I said before, diversity is absolutely key. Anything you're going into, try go into it with an open mind. Try, if it sounds too good to be true, take it. If you take anything away from today's talk, it probably is too good to be true. So if an investment's promising you a 50% return on year 1 year, the likelihood is you just got to ask yourself how they're achieving that. And if it was so good, you'd have every single hedge fund in the world jumping onto it. Just to give you some scale about the steps some hedge funds that go to try get just a nanosecond of advantage. Some hedge funds run their own fiber optic cables between London and New York, just to be able to get literally 10,000ths of a second speed on everyone else. Try to create an arbitrage trade in the high frequency trading space. There was a parking lot opposite the New York's stock exchange server. It's just outside of New York. There was a parking lot that sold for, I think it was about $4 or $5 million, just because people could put their server racks there and just have that nanosecond advantage of other people. So, our philosophy is, the likelihood is you're not going to outguess the market. The likelihood is you're not going to be able to time the market. The likelihood is, you might get 1 or 2 calls right, but you're not going to get them consistently right all the time. So one of the things you can do is let the markets do what the markets do. The markets have been doing this since the early 1990s. Markets in London in terms of the commodities have been going for hundreds and hundreds of years, and generally we are of the opinion that markets are efficient. If you're reading an article that says buy this share in tomorrow's paper, the market knows about that share, and the information out there has been disseminated and analyzed, and people have really jumped on it by the time the editors proofread the article and it's been put through compliance and the lawyers have had a look at it. So the key thing is just remember that put that the roadblock, the foundational steps in place, build up a solid grounding, a foundation for where you want to get to. Make use of the opportunities that are available in the countries that you're investing in. So in the UK, we've got things like pensions and ISAs, which give you tax relief and effectively, give you a top up on your investments. So if you invest, £20 in a pension, you gets grossed up to £25 instantaneously. ISAs are things in the UK that are tax-free, so it's a great mechanism to build up. There's greater investments for children to kind of preamble the potential property purchase in the future, things like junior ISAs and lifetime ISAs and things like that. So there's a myriad of opportunity out there to make use of your money. One of the questions I always get for members of the conference in the UK about pensions is are they good, or should we we've heard horror stories of pensions. Absolutely, by bar none, they are one of the best investment vehicles out there in the UK, because very few investments give you the tax relief instantaneously. Government's effectively giving you free money to put your money into a pension. And there's some tax advantages if someone was to pass away from their pension. Their pension fund does go to their family. If that's who they've appointed, it doesn't disappear with you. There are some final salary pensions in the UK that they do have quirks that they go to the spouse. But effectively, they're great mechanisms to kind of put you on your roadmap and give you the building blocks to move forward and give you the opportunity to build your roadmap and your future path. And let your investments grow. So Tendai's got my contact details. I work closely with Tendai on a regular basis, and I love speaking at these conferences, giving people an insight. I think one of the comments someone brought up was, are we in a bear market? And the speaker previously mentioned, absolute, the market is technically in a bear. The second quarter GDP figures were technically, the end date was yesterday. So the likelihood is, if we're not technically in a recession in terms of the US and the UK, by next quarter, the likelihood is we are going to be in a recession. And again, this just comes down to the information that's available in the market. Everyone kind of can see it, and you probably know yourself. If you've got a below inflation pay rise, employers are kind of putting the brakes on things, and so the economy is slowing. I regularly commute into London, and compared to 2 years ago, the trains are relatively empty, and there's fewer people walking around. So that's naturally going to have an impact on the economy. So these are things that are just everyday occurrences in the market. We go through cycles of recessions and bull markets and bear markets, and this is where the key thing to do is not kind of try to time that market, say, we're in a bear market, it's not a good time to invest. And the complete opposite is true. This is the perfect time to invest. Not only are you getting a discount on the exact same investments you would have got if you bought them 6 months ago, but you've got that opportunity of buying at a technical dip. And I'm not saying the markets can't drop further. Anyone who tells you the investments just go straight up is technically lying to you. But this is, you can use these mechanisms and these timings to get into the market at these times. And, things like pensions and investments you can do on a regular basis, which is always preferable in our opinion than dropping lump sums in. It gives you that opportunity to buy in, and we call it pound cost averaging. So you're buying it at different price points, and over the time you're getting a decent average. Certainly if you buying crypto, if you're buying at 69,000, then you've probably got a serious hangover in the last few weeks. Whereas if you consistently bought small amounts from 2013 when it was in infancy, then I think it was probably about £1 or $1 in 2013. If it dropped from 69 to 20, you're still up on the vast majority of your assets. So it's about kind of, as I say, making use of what the markets do. Don't try second guess them. Don't try time them. Take your first step in your pathway to financial freedom. Make use of the investments and the options that are available to you. Regulated. We obviously don't advise on unregulated investments, but things like property, as I say, I'd much rather a client have a buy-to-let and a pension than just a pension. I'm never going to kind of discount the fact that there's £1,000 of income from a buy-to-let in retirement that I don't have to take from the pension pot to cover expenses. So hopefully you guys have found that worthwhile. If you want more specific details, more than happy to answer any questions, and we can take it from there. Tenda, are you there?
I had been lost in some space there. I'm here. Thank you so much for that, Alan. That was very informative. Does anybody have any questions for Alan? You really reiterated a lot of points home. There's no such thing as a free lunch. No such thing as a free lunch. That one is, yeah. We all want the freebies, isn't it? We want to get rich quick. Don't want to put the work in. A lot of people don't, but yeah, that was. Any questions? Someone's asking here in the chat. What is there? Oh, someone's just saying thanks, Alan. Any questions for Alan? No? Thank you so much, Alan. We are going to move on to our next speaker. Let me just get him up.
Sorry, Taylor, there's a couple of questions coming in.
Okay. All right.
Nigel asks, is price earnings ratio a reliable way to evaluate a company? Yeah, absolutely. And there's various kind of measures of PE ratios. What you tend to find is different kind of metrics that people apply to companies. So, high growth companies obviously have a much higher PE ratio, compared to the more kind of stable companies. There's the skilling PE ratio kind of metric that takes into account inflation. One of the metrics that people are kind of assessing the market on, where we are with bear markets, is the PE ratio. On average, do we need to drop further to get to the bottom of the market? It's one metric that is probably the most widely available out there. We always have the opinion that companies that make money are going to probably have a better chance of being around than a company that doesn't make money. So some of the investments we use have a slant on size and profitability. Generally over history, smaller companies are going to outperform bigger companies. So some investments we use have a slight slant onto smaller companies. Do we do investment portfolios? Yeah, absolutely. So we advise clients on how to invest their money effectively. So we act as the middleman, finding the best investments for clients, whether that's kind of just pure passive investment portfolios or really specific active clients. The new kind of kid in the block is ESG, ethical, social, and governance kind of portfolios. So we can tailor things with a kind of an ethical or an activist investment stance. So that's what we can do. I can disseminate my contact details, guys. It's
I'll do that. How do I ensure I don't get charged a lot to invest? How much is okay to pay for a company like Vanguard to run my investments?
Yeah, so the charges are a key thing. The value is the metric we kind of instill to clients. You get what you pay for. Vanguard is obviously a world leader in terms of index funds. There's a couple others that do similar things. So in the index space, Vanguard's probably more expensive than some other ones. So, but Vanguard does a very good job. So what you do want to do is not pay too much for your investments. But what you don't want to do is go for the absolute cheapest just to get price. And generally, if you're going for the cheapest, if you're not paying a professional to do it for you, the likelihood is you're going to end up with a worse situation. The whole entire financial services industry is around because it adds value. If we didn't add value, if it wasn't worth paying for advice, we would just disappear as an industry. So, as long as we can continue to add value, that's more money in your pocket at the end of the day.
Which door do I knock on? I'm serious. I wonder should I unmute you, Albertine? Can I unmute you? Let's see. Do you want to lift your hand up, Albertine? Raise your hand and then I can... There we go. We get your question out properly. There you go. You can talk.
Oh, hello. Hi, Sundai. Thank you.
That's okay.
Yeah. No, I was just really interested in investing, and I've heard that if you are going to invest, you need to make sure that you go for the companies that you don't pay too much for the investment. So I want to understand what is an acceptable amount to sort of pay for investing, because all the books that I've been reading on investing, and I've been reading a lot, have been by people like Chris Hogan, and then he's had some really great ideas, but they seem to work for a United States market rather than a British market. And I actually was looking for this particular type of investing that he suggested that will give you you pay really, really little. And I was going to ask during this session the equivalent of that in the United Kingdom. If I find it, I'll probably contact Alan and ask him. I can't think of it right now. Yeah, that's
yeah. So just to give you a kind of ballpark figure, I mean, a simple index fund in the UK, ranges from kind of probably about 9 bips, so 0.09%, to probably on average, I'd say 10 to 15 bips for a typical passive tracker fund. When you start to look at kind of the nuanced tracker funds that kind of try and get a outperformance, so they have a specific slant, you know, you're going to pay a premium, and that ranges from 10 bips to some of the kind of more expensive funds are 1.8, 1.9%, and you kind of ask why you're paying 18 times more for a specific fund, and the reason is you expect outperformance either on a beta metric, so outperformance of the market, or alpha, on a Sharpe ratio, which is outperformance on a risk-adjusted ratio. So, the example I always give clients is a hedge fund typically has a 20% performance fee. So if they make you 100 grand, you technically are giving away 20 grand. And, I've never met a client who's besmirched them for paying a performance fee, because you only pay it if they make you money. So this is where the whole concept of, going cheap as chips. Yet, if you're going to stay on top of your investments, you can absolutely do it. And if you have to pay a fee, it's just about, are you getting value in the long term? Are you in a better position paying that fee as opposed to not? And that's something we kind of have conversations with clients all the time, demonstrating the value add, what are we adding? And, it becomes a difficult conversation if year on year we aren't adding value, because, clients are more than welcome to just pack up and say, we're moving on. So it's just about that. But yeah, ballpark figures, they're super, super cheap investments. The UK is probably the second most advanced investment market after the States. Through efficiencies and through the systems, things like Japan are super efficient, but it's more localized. New York is the number one financial center in the world. London is number two. Then Tokyo, then Frankfurt and Singapore and things. But if you look at the scale, nothing touches London or New York. So you are going to get efficiency by investing in the UK.
Okay, thank you.
Awesome. Thank you so much.